want to trade like a rebel, you got to come to Rebelcon 2022. It's going to be in Dallas, Texas, at the fabulous Four Seasons Resort. It will be more fun and more live trading than we've ever done before. That's why it's called Rebelcon 2022. We're going to have barbecues and double the amount of live trading. The guest speakers, as soon as we announce those, this thing's going to be sold out, limited to 250 people. Sign up now for Rebelcon 2022 at the Four Seasons in Dallas, Texas.
Welcome to the Rebellion.
And welcome back to all of our Market Rebels, and happy Thursday, everyone. And I got a little bit of good news from PPI this morning, so looks like we're still potentially trending higher, but certainly not out of the weeds yet. And of course, that's one of the things that prompted us to start trading tune-up, to give you some ideas, tips, and tricks to help you make better decisions, and especially during volatile markets. Now, one of the things that traders often turn to for volatile markets is a vertical spread, and for good reason. Vertical spreads are incredibly powerful, very versatile tools. I don't know of a single professional trader or even very astute trader that doesn't use vertical spreads. But one of the things that I find that traders try to do is to leg in and out of vertical spreads. And so if you don't know what that is, we'll talk about that in a minute, but it also poses a lot of risks. And that's really what I want to show you today. Give you something to think about if it's really worth to leg in and out of a vertical spread. So there we go. So the risk of legging from vertical spreads. Now, when I'm talking about this, I mean either legging into a vertical spread or legging out of a vertical spread. And we're going to talk about both of them. But for a vertical spread, you have two basic ways to enter. Okay, so let's say that we're going to buy the June 100-105 vertical spread. We could just buy that right out. Enter it into our broker's platform as buying the 100-105 vertical spread. However, we could also just buy the $100 call and wait. And a lot of times traders do this because they say, it looks like the market's really, maybe in this case, bullish. I'm going to see if I can squeeze out a little bit more out of that 105 call. Instead of selling it for the current market price, I kind of feel like the market's going up so I can get some more out of it. And really, in a best case scenario, maybe I can get even more than what I paid for my long, get myself into a free money situation, so to speak. And so what we do there is they might say, okay, well, let's sell the June 105 call at a later time. So this second method right here, where we are breaking them apart, is called legging into a spread. Okay, each of these trades is a leg of the position. And so what we're doing is we're just taking the first leg, buying the $100 call, and then at a later time, could be later on that day, could be a few days, week later, whatever. But at some point in the future, we're going to sell that second leg. Now, just for a little side note, could you start out by selling the 105, have it as a naked call, and then later buy the 100? You could. We don't ever advocate that here at Market Rebellion, and for very good reasons, such as we've seen during COVID and during even recently here. Of course, that's to the downside. But you can have things like that happen to the upside as well, and it can put you into a really bad position. So if you're going to leg into a vertical, you should always take the long position first. So let's take a look at some examples, legging in and out. So again, the whole premise is that sometimes traders either add to their positions or subtract from them, again, based on what's happening with the market. And again, this is what we call legging in or out of trades. And it poses a very big risk that people are usually not familiar with. Sometimes we'll call this morphing, changing the shape of the risk graph. But again, for our example, let's say we're going to buy the 100-105 call spread. We're going to buy the $100 call today and sell the 105 call in the future. So if that's the case, we have legged into the 100-105 vertical. So let's take a look at the risk. All right, let's say we can buy the $100 call outright for 10 bucks. Right, so it's minus 10. It would cost us $10 to put that position on. We could simultaneously sell the 105 call right now and collect 8. So we're just assuming these are the current market prices, in which case the 100-105 vertical spread is trading for 2. That's our net debit. We've spent 10, we've collected 8, so we would have a net cost of 2. And therefore our maximum loss would be 2. That's the amount that we spent. And the max gain would be 3. Max gain is 3 because we have the right to buy at 100, the obligation to sell at 105. That's 5 points maximum, no matter how high that stock price goes. But because we spent 2, that could potentially land 3 in our pocket. So that's where those numbers are coming from. However, what if we decided to leg into this position? What if we buy the $100 call for the current market price of 10 and we wait? And what we're going to do is to hope that we can get more than 8 for this 105 call. In fact, maybe we would say, oh, the market's on fire right now. Maybe I can even get 12. Maybe I can get more. Paid 10 here for the 105. Maybe I could collect 12. Be almost like sort of like an arbitrage. It's not an arbitrage because it didn't occur at the same time, but I could get myself into a situation where I can't lose. So once again, this is the idea that a lot of traders get, and I just want to show you, I'm not saying it's a bad idea, but in a lot of cases, it's a bad idea because they don't understand the risks that they're taking, and that's really what you have to understand. So here's the one that we've outlined so far. There's our bend at 100. There's the second bend at 105. Max loss of 2, that's our cost, and therefore a max gain of 3. So this is the risk graph that we could choose to do right now. Okay, so remember we could spend 10 and collect 8. That would give us 2. So we can throw ourselves into this position. We've got a bullish position. We get our maximum gain at 105 at expiration. But we could also wait. And if we do that, here is the comparison. This is one of the most important slides because this is what people overlook. If we take the $100 call for 10, notice that our bend is right there at 100, just like it is for the black vertical spread. But look at how much lower it sits. Okay, we've got a maximum loss of potentially 10 instead of just 2. We've also got quite a bit before we hit this crossover point up here. So we have to say, is it worth taking this additional risk? Okay, because remember, it doesn't matter how bullish you are or what you think. As we've talked about, the market doesn't care what you think. You can think all day long that the market's going higher and you can sell the second option for 12. There's no guarantee. And so now you're at risk of losing 10 instead of 2, and you're still just going to have a limited gain. All right, so you're just going from this nice unlimited gains to this of a limited gain, but you're just going to do it over time. So let's take a look at another angle of this. The first set of numbers I put were for 30 days to expiration. I think I had a volatility of something like 85 to get that call option to go to 10 bucks. And here's where you can stress test your positions. Pick some dates. Let's say 10 days later, put it into a pricing model. The stock would have to be at 111 in order for me to get 12 bucks for that second option. And if it's at 111, that means I could have sold my $100 call for 15, according to the pricing model. The 100 call would have been trading for 15. So I have a choice. If I really think this is going to happen, I can spend 10, sell for 15. That's 50% gain. That's 5 bucks in my pocket. Or I could sell that option for 12 and then shift from this black to the green. And you have to ask, is it really worth taking that additional risk for just this marginal gain? And remember, we've put 2 bucks in our pocket right here. potentially have 7, but there's no guarantee. This is just what we're hoping. We've locked up 2. We might get the difference in strikes of 5, but because we have a $2 guarantee, it's now a $7 maximum. Well, we could have had 5 for sure, and we're swapping it out for 2 for sure, and maybe 7. See, this is the analysis that you have to look at. You might squeeze out another 2 at the risk of losing 3. And this is the thing that most traders just never think about. Now, also take a look at this crossover point right here where the red and green lines cross. What is that going to be? That's going to be, if this is 7 up here at the top, right? Here's delta 1, that's 7 points. This is 117 where these lines cross. You would have to be at 117 for those to be equal. You have to say again, is that really going to be something that you're expecting? And even in that case, the best you're going to squeeze out is another 2. And yet you're taking all of this risk for that. So that's the thing that I really wanted to emphasize here. Easy to do in a pricing model. And we just did one where I said assume that 10 days have passed. Do it with maybe 5 days have passed, 7 days have passed. Do 4 or 5 and kind of get an idea of your trade-offs. And this is also why it's important to understand your risk graphs. Okay, so then we have to say, I could have put myself on this black curve for sure, but in exchange, I'm going to go to the red first to maybe get to the green. When you look at that visually like that, you have to say, is it really worth it to take that much extra risk to maybe squeeze out this extra gain? And that some cases it might be, but in most of the cases, I think you're going to find that it's not. But that's what I want everybody to at least start thinking about. Now, let's take a look at the second part of the problem, risks of legging out. That was legging in. We're going to take leg 1 and at a later time sell. What if we have both positions and we decide to ditch one of them? Stock's going in our favor and we want to leg out of one side. Well, here is the danger that people have. And again, it's an accounting error. We talked about this on Monday, I think it was, with the man in the green bathrobe. Remember that, with the mark to market? And that's really how we have to see the value. But this screen was actually shot when Amazon was back at about 2,700. And I still want to use that just because it emphasizes the point. A lot of times traders are using verticals during very high volatility or for very expensive stocks. So let's say that we have the Amazon 2,700, 2,705 trading for 2. Again, max loss is $2. And here's the way that it looks. Let's say that the $2,700 call was trading for 60 and the 2,705 was trading for 58. So we spend 60, we collect 58. That's where the net 2 is coming from. But now at a later time, it's moved in our favor. The stock has gone up and we go, oh, you know what? I shouldn't have sold that 2,705. I knew it. Let me buy it back. And so traders will say, well, I collected 58. I'm going to spend 59. So I've lost $1. And they'll say, therefore, I now have $3 into the position. I can't tell you how many times I've talked to traders and they'll say, well, I spent 2, I've now spent another $1, and I therefore have 3. This is absolutely wrong. This is the big mistake about legging out. Here's the way you want to look at it. When we were long the 2,700, we spent 60. We sold the 2,705 and collected 58. But then we spent 59 to close out the 2,705. So it's all of these cash flows. And that's going to mean that we are now long the 2,700 for 61, not 3. That's a big difference. Okay, if you did the spread, presumably because you didn't want to lose 60, now you just put yourself on the hook for 61. And traders just don't understand that. So here was the original call. And then look at this. Down here it's 61. Okay, so you have to say that even here, look at that additional amount. So you have to say that if we are willing, or are you willing, to take that much additional risk just to free up this upside? So if we look at it from the vertical spread, look at that. This crossover point right there is 2763. You need that stock to go to 2763 just to be indifferent between those two positions. And yet in the meantime, you're going to open up this much downside risk just to cut that short position loose. In a case like this, I wouldn't even dream of doing it. And yet I see people doing this all the time. So I just wanted to point out some of the basics, some little calculations you can do to make sure you don't step into these traps. Very common and very easy to do with vertical spreads if you ever decide to leg in or out. So with that, we'd like to invite you, for anybody who'd like to learn more about some of the intricacies and some of the more advanced techniques for options trading, you can get a free 30-minute one-on-one consultation with one of our world-class coaches, absolutely free. Chat with you about anything that you want. It could be an actual trade that you're doing, just different techniques, and see what they can do to open your eyes to new ideas. And that can only mean better decisions. So there's the phone number is 888-809-8058. And I hope that helps. And I will look for you tomorrow at 4 p.m. Eastern when we talk about our last topic for the week. And I look forward to seeing you then.